and welcome to another ACUMA Fast Track. My name is Peter Benjamin. Today's session is going to be fantastic. We're very fortunate to have a representative from NCUA joining us today as we discuss the agency's 2023 exam priorities. Before we dive in, just a few housekeeping items. This session is being recorded and will be posted to our website at a later date. I will be monitoring the chat. Feel free to ask questions, and I'll do my best to weave in the questions along the way. And finally, we have a lot of great things happening this year, and we couldn't be more excited for our second in-person event happening in Arlington, Virginia, right outside Washington, D.C. on April 18th. This is a free, yes, I said free event for credit unions, members and non-members. Registration is still open. I promise you're not going to miss this event. I had the privilege of speaking with our subject matter experts last week, and I was blown away with their presentations. This is an event that you must attend. And I guess finally, before we transition, a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The webinar and its material are presented as a set of ideas and are possible strategies regarding its specific topic and does not represent any endorsements of either the presenters, their firms, or the concepts they present. Okay, that's it for our housekeeping items. Today's webinar is being brought to you by Meridian Link. Joining us today is JP Kelly, Senior Vice President of Mortgage Lending. JP, come on in. Welcome.
Hey there, Peter.
How you doing?
Good. Thank you. Thanks for having me.
Of course. Well, thank you. Thanks for being here, and thank you and really Meridian Link for sponsoring today's session.
Glad we could do it.
Awesome. Now, JP, I think you can agree that today's topic couldn't be timelier. You know, with everything that's happening in the news lately, this has potential to be a huge topic for credit unions. One that I know that our members are quite interested in. Now, before we transition to our subject matter expert, first off, JP, congratulations on Meridian Link's recent acquisition of OpenClose, a company I know you co-founded over 20 years ago. Now, how has the transition been going? Walk us through your new role. What are the immediate improvements that you and your clients are seeing?
Well, how's the transition going? Well, I guess the first aspect is it's the first time in 25 years I now have a boss. So that's a little bit of change. But it's been great so far. For me, the transition and our team has been going extraordinarily well. Even though Meridian Link was a much bigger company and I didn't know what we were in store for joining a much bigger group, it's a great fit culturally. The culture of Meridian Link is one to where they have a strong entrepreneurial spirit to it, which has been really exciting for myself and the team. My new role as the SVP of Mortgage, essentially what I'm doing in that new role is leading the strategy for the mortgage business, which includes both the Meridian Link mortgage products as well as the OpenClose LOS products. As far as the immediate improvements that we're seeing, that I'm really excited about is now we're able to really leverage the concepts of scale of being part of a much larger organization, which will allow us to have the resources we need to bring more innovation to our credit union customers and work with the other Meridian Link products that we have to create higher levels of efficiencies across all of the credit union business channels. So that's a real exciting factor that I've been focused on.
I love that. Now, with the acquisition, it's said that together, Meridian Link and OpenClose. Now, I read this in the press release. The press release said that Meridian Link and OpenClose will usher in a new lending technology era, which I love. That will better serve credit union clients and the mortgage industry. Can you provide us an example of that, please?
Yeah, so on the short term, one of the biggest changes for the Meridian Link mortgage customers is they're going to be able to take advantage of the open close point of sale system that we had. We're calling that product Meridian Link Access. We're in the process of integrating that now to the Meridian Link mortgage products. In fact, our first customers are going to pilot on that shortly. So that'll be happening here in the next month or two.
That's great.
The new POS, Meridian Link Access, will greatly enhance and streamline the application process for our credit union members. For the open close customers, we're going to be integrating the Meridian Link's pricing engine, which is called Price My Loan. That's going to bring a significant amount of pricing enhancements over what the open close customers have today. We demonstrated that to roughly a dozen of our current open close customers, and people have been so excited about it. We've had tremendously positive feedback on it.
That's awesome. That's awesome. Thank you. Now, I love learning about new buzzwords. And it seems like we'll say the technology or tech industry's word of the year or buzzword sort of say is, or I really say buzzwords is efficiency. And that's kind of sort of closely followed by, cost effectiveness, right? So to that point, using these buzzwords that I love learning about, how is Meridian Link leading the way for their clients to enhance, the efficiencies and reduce costs?
Yeah, efficiencies and reducing costs are more important than ever, obviously, with the change in where the market is today. The two key areas we're really focusing on is the first is the user experience, with the goal of providing a frictionless experience for your members. Our new point of sale system is our foundation to that modernization of the user experience, which is going to allow the members to effortlessly complete a loan application. In many cases, pre-populate the data if they've applied for loans in the credit union that you might have in other Meridian Link systems. They can submit conditions on their loans, they can check pricing, and at any time, 24/7, they can look up the real-time status of their loan. The second is connectivity. At Meridian Link, we have several products, not just mortgage products, that serve our credit unions, from account opening, car lending, consumer lending, small business, mortgage, just to name a few. We've created the Meridian Link One vision, where we're focusing on creating connectivity, or what we like to call connective tissue, across all of our various product lines. That's going to allow our credit union customers and the members the ability to interact in a much more efficient manner. Having connective tissue between those applications, it's powerful, because your members and your employees don't have to waste time re-entering data, seeing what other loans they might have with the credit union, of that same data over and over across those disparate systems. It brings it all under one umbrella, so to speak.
Right, a nice firm ecosystem, which is fantastic. That's awesome. Okay, now, are you doing anything specific for credit union clients to gain competitive advantages? Improve their nationwide network, or other suggestions for their future roadmap?
Oh yeah, we are definitely. Beyond what I mentioned in regards to our Meridian Link One vision, we spend a lot of time emphasizing connecting our credit union customers, both virtually and in person. One thing that I've noticed over the years with open close, and obviously what everybody at Meridian Link knows, because they have such a strong footprint in the credit union space, is I love how credit unions interact with each other. It's different than a lot of other companies in the industry. Credit unions love to share ideas and figure out how to do things more efficiently, with the ultimate goal and focus on how best to help their members. At Meridian Link Mortgage, we hold virtual quarterly meetings with our credit union customers, and what we like to get together to discuss market trends, the roadmap items that we're pursuing, hear about key areas that our customers would like us to focus on, and it's a great forum for them to interact and network together. And we even see online, when after those meetings and throughout the months where the credit unions, they'll ask each other questions. They'll be their own, hey, what's the best way to do this, or the best way to configure the system to do that. It's a great forum that allows people to share information. We also host in-person user forums, which is open to all of the Meridian Link customers. It's a great venue to interact with Meridian Link team members who they talk to on the phone all the time and meet new people, as well as interact with all of our other credit union customers. In fact, our next forum is in early May. It's right around the corner, and it's at Disneyland. So anybody who's listening who hasn't signed up for that, check it out on our Meridian Link website. You can register for that conference.
That's right. You can have a business trip and a family vacation all at the same time.
That's right.
I love it. Well, JP, thank you again. I truly appreciate your time today, and thank you for sponsoring today's webinar.
Oh, thanks for having me, Peter. I appreciate it.
Take care. All right, so turning back to why we're here today. Today's session focuses on a topic that, in my opinion, couldn't be timelier. As we think about everything that's happened in the last year or so, essentially an about face in mortgage rates, the near extinction, of any sort of refinance in the market, which really results in a resurgence of home equity. Plus, when you factor in falling inventory, there's, I guess, plus when you factor in recent events, some policy changes coming out of FHFA, a welcome focus on appraisal bias in our industry. And to top it all off, and this is really a mouthful, news coming out of the banking side of our industry. So it should be needless to say, but I'm going to say it anyways. Having a good understanding of our governing agency's exam priorities is key to our success. Today's speaker has been kind enough to join us, and will impart some valuable insight into this subject. Now, it's my pleasure to welcome Amanda Parkhill, the Deputy Director at NCUA's Office of Examination and Insurance. Amanda, how are you doing today?
Good. I'm happy to be here. Thanks for having me.
Oh, my pleasure. My pleasure. Now, if it's okay, I want to jump right in. Do you mind?
Let's do it.
Okay, fantastic. Fantastic. All right. So since the NCUA's exam priorities were laid out in a letter to credit unions, the financial industry world has changed considerably. This is a two-part question. I may have a few two-part questions, but this is the first two-part question. How has the recent bank, failures impacted the NCUA's exam and supervisory approach? So that's part one. Mm-hmm. And part two, of that change, what's going to stay the same?
So for this, I'm going to kind of focus on liquidity, because that's where the shift
fair.
Has been the last few weeks.
Fair.
So liquidity did, pop back up earlier this year as a supervisory priority. It's been on and off the list for the last several years, as many of them are. We have a lot of repeat issues or topics that come up. One thing I will point out this year, we did make an effort to really pare down the number of supervisory priorities we have. And that came from feedback from the industry and even our own staff, that if everything's a priority, nothing's a priority. And so liquidity was one of those few that made the list. And I guess just thinking about how we got here. So obviously, many of you probably remember back in 2020 and early 2020, because of the uncertainty around COVID and how that would affect the economy and financial institutions, we really took some proactive steps around liquidity and making sure that credit unions had access. And, there was fear of either a run or a liquidity shortage. And so it's where we started. Of course, over the course of the last couple of years, things changed as we saw an influx of excess liquidity, which kind of created new concerns around interest rate risk and even credit risk of how credit unions were using those funds and what they were doing, taking potentially unstable or short-term deposits and either going out long-term or in higher risk assets. And then we started to look, at the end of last year, couple things were happening. We were seeing a runoff of those deposits combined with the unprecedented, high increase in interest rates, which of course leads to reduced cash flows. So again, a little bit of concern about a potential liquidity crunch, and made it a priority to look at for 2023 to make sure that credit unions had access to liquidity and were managing it appropriately. And so we were fairly well positioned, I guess, that, with the recent bank failures, that we didn't have to shift focus too much. We're still looking at and making sure credit unions are able to obtain liquidity if they need it. Also really focusing on balance sheet composition.
Right.
Really highlighted the importance of borrowing, I think, both in good and in bad times. Obviously, when it's necessary, credit unions need to have access to it, but it can also be a really useful strategy and sometimes maybe a lower cost of funds for credit unions to utilize. So I think something that's come up over the last month has been really addressing this potential stigma around borrowing that, for many, many years, especially in the credit union world, it was either thought of as a red flag, or that if credit unions were borrowing, it was because they were in trouble, and that's not necessarily the case. And so we're really making an effort to dispel that myth, both in the industry and with our staff. And so I think that's kind of one of the changes that we've, made over the last, adjustments over the last few months. But I will say overall, you'll probably hear the same questions from examiners and see the same thing of, do you have access to liquidity? And even, related to that, compliance with regulations. I think if you're over 250 million, you need to have a contingency liquidity source. I would encourage all credit unions to have that, but definitely if you're getting towards that size, to make sure that you do. And then again, just agency-wide, we're looking at ways to provide support and options for credit unions that need it.
Okay. So, I guess really kind of coming back to that second part of that question, which is, things have changed at a rapid pace recently, good and bad. Do you foresee some of these changes staying the same kind of going forward, at least the foreseeable future? I mean, I know we're not here to, this is not an economic conversation, but the potential for, a recession comes more real every single day. Do you anticipate this staying the same for the near future or long term?
Definitely for the near future. And then again, long term, I would imagine liquidity, interest rate risk, and credit risk are usually kind of the top three. They've been priorities on or off for the last decade, will likely continue, just because that's where the bulk of the risk is on a credit union's balance sheet. And again, it's really looking at, not just those individually, but overall balance sheet management and how credit unions are managing any risk that they take on.
Awesome. I think that's a good segue to the next question, which is, there is, a decent amount of chatter in the credit union world about the increased emphasis on, the ALM in light of some of the balance sheet weaknesses demonstrated at the failed banks. That's a mouthful. Please talk about how that will show up in your exams for the remainder of the year and maybe beyond.
So we did just recently separate out, right, in CAMELS, the L liquidity from the S sensitivity market. They used to be combined under one ALM kind of rating. And we separated them out for a variety of reasons, but the reality is they are very intertwined. And so ALM, I'm getting my acronyms. I'm also BSA, which is
CAMELS,
AML.
CAMELS, ALM. We can do this. We're in this together.
Yeah, so ALM is still really important. And again, it ties into that entire balance sheet management of not just looking at one piece of it. So obviously one effect of the higher rates recently has been, changes in the value of investment portfolios, which again is only a concern if credit unions have to sell or need that liquidity. So it's, in addition, again, to looking at access to liquidity in the event of a crisis, are they managing their current liquidity levels? Are they utilizing all options? How are they, funding all of their assets? And our training to our examiners has really focused on that. And I think it's important to kind of think through, there's been a lot of turnover in the industry. And so a lot of credit union leaders haven't led through either a liquidity crisis, high interest rate environment, or a crisis. And so, and that's true for our staff as well. We have a lot of, examiners that weren't in the workforce during the 2007 recession. And so it's kind of taking those lessons learned, training people, providing guidance to the industry. And also, we are in unprecedented times that we haven't seen rates increase this way in a while. And so adapting and trying to stay one step ahead of what's coming.
Okay. So, thank you very much for kind of walking us through, well, I'll call that balance sheet management, right? Between, the idea of, let's focus on liquidity and, obviously that, the ALM risk controls, right? So let's kind of sort of pivot to, credit and lending, more specifically mortgages. Credit unions are trying their best to help as many members fulfill their dream of homeownership. But let's face it, when we become more proactive, we sometimes extend credit to certain borrowers who may misrepresent themselves. Sorry, tongue twister. But bottom line is, they're providing inaccurate or even fraudulent information when they apply for loans. This is also is seen. Really, we see a large increase from this whenever interest rates jump up, right? Especially at what we saw in the past year or so, interest rates jumped up. Basically, I want to say for the lack of to not have to do math, doubled in a very short period of time, right? So again, another two-part question. What can credit unions do to step up their, we'll say, vigilance on this? And two, what is the NCUA doing to monitor and prevent that fraud?
Yeah, so that, a lot of us remember 2007, 2008 when that was very prolific. So yeah, fraud's never going away. We can do our best to find and deter it, but eliminating it is, not realistic. And, just like when interest rates go up, there's an increase in fraud during times of economic hardship. Fraud's going to increase. We're also dealing right now with a hybrid or remote workforce that maybe creates more opportunity for fraud. And then just technology, as technology changes, there's more opportunities and ways for people to commit and hide fraud. And so we're always having to stay one step ahead of that. So yeah, we encourage credit unions to be vigilant and not only focus on maybe what's currently happening in fraud. I know I've been in several meetings the last few months that I guess check kiting is becoming hot again. And so I know, right, as credit unions are trying to put out that fire, there's other things brewing and starting to flare up, such as potential mortgage fraud or loan fraud. So yeah, just being proactive and having really sound policies, anti-fraud policies, procedures, training staff. They're going to be the first line of identifying something that doesn't look right as far as member fraud. From NCUA's perspective, we have a lot of resources for credit unions on our website, but I will say that a lot of our anti-fraud or fraud prevention is focused on internal fraud, because that's kind of where what we see as examiners in the institutions and where a lot of the losses come from. And so I recognize that credit unions kind of have it from both sides of having to manage potential fraud from within, but also what your members are doing as well. So yeah, having good policies in place, making sure everyone's aware, and just a really strong culture around, identifying and bringing things to other people's attention that maybe, need to be investigated.
Okay. It's interesting that, it's not interesting. I'm happy you said training, right? I'm thinking back to when I was at a credit union and ran a mortgage division for a credit union. I put together a pretty much a learning management system document. Basically, these are the trainings that my mortgage team will go through, and the good portion of them were fraud related, how to spot fraud, the different types of fraud, and maybe that's the key to success is knowing that there's, especially when it comes to mortgages or lending or any type of credit. I mean, it's not just one type of fraud. I mean, it's 10, 20 different types of fraud, anywhere from straw borrowers to, fraud for property. It's so I'm happy you said that having those documented training routines is really important. Thank you very much for that.
I guess just to add on to that, it is important that even though fraud's always evolving and technology is being used, right, just like check kiting's coming back, a lot of the ways that fraudsters go about it are tried and true and kind of reappear. And so, yeah, a lot of like looking at the lessons learned of where have credit unions experienced fraud in the past are going to be helpful going forward.
Right. I mean, it's, you said it also, technology evolves, right? There's new ways for people to commit fraud, but they kind of always go back to, the tried and true methods of trying to commit fraud, which is silly, but sometimes it does work, unfortunately.
Mm-hmm.
Which more training. All right, very good. So, we dipped our toe in the fintech conversation. Fintechs have been in the news lately. Unfortunately, it's been unwelcome news. And especially as it relates to the high profile bank failures. And I hate the fact that I keep using that, but that's how it's being framed up. But realistically, fintech lending can be and will be an increasingly important part of credit unions' lending portfolios. Now, the NCUA recently issued supervisory guidance on this. What can you tell us about the things that the NCUA is looking for? And what additional guidance can we expect as things expand in this section? I mean, technology changes every day, literally every single day. So walk us through this, please.
So I'll first start saying NCUA, and I know all of the board members are very supportive of credit unions using fintech. There's so much value, as you said, in all kinds of ways they can offer products and services to members. We're seeing some really interesting and cool things in the lending space of how credit unions are able to either make more loans, make loans quicker. I know appraisals like have started to get into the fintech space, which is really fun. So most of our guidance to date, and I think a lot of what you'll see is really for credit unions to focus on due diligence. And again, this is not new. This has been an expectation for, anytime a credit union is using a third party, is that they understand who they're dealing with, what they're getting into, and what any potential, downside or repercussions are. And so a lot of our guidance related to fintech is around just that, credit unions needing to understand and complete their due diligence so that they feel comfortable with, again, whatever product or service they're offering. So yeah, I think you'll see a lot of that. How they do the due diligence may change, right? A lot of fintechs may not have 10 years worth of financials or other ways that they've, kind of vetted companies in the past. And so we're flexible on how they do that. But the key point is that they're doing something and understanding, again, the risks that they're taking on. I know several times when I was an examiner, credit unions would tell me about this great new product they had and say that there was no risk. And that was always a red flag, because that, of course, is not the environment we work in. Everything has risk. And it's just a matter of how well you measure, monitor, and, manage it. And if you don't know what the risk is, you can't properly manage it. So I think that carries through with, the use of not just fintech, but any third party. And, fintech is a new term, but not really a new concept, that credit unions have been using third parties or creative ways of providing services to their members for many decades. And so, the expectations that were in place will continue to go forward.
Okay, very good, very good. Next question. So, and this is one that this is a topic that, you know, I think our membership feels very passionate about. You know, we I guess now 2 weeks ago, 3 weeks ago, we were at our first in-person event, and this is a topic that we discussed it heavily because it's important to the NCUA, it's important to us. But but I'll come back to the question. The NCUA has made it clear that there will be a greater emphasis on fair lending and equality in the lending process. You know, I mean, we can talk about, you know, DEI initiatives, we can talk about PAVE. I mean, we can talk, there's a lot of stuff about this. You know, what can credit unions do from your point of view? What can credit unions do to ensure that we support that their lending practices support and really comply with the NCUA is looking for?
Yeah, I mean, this one's kind of easy, I guess, because the laws are very clear cut of what the expectation is. And so, you know, being familiar with fair credit, fair lending regulations and making sure that you have a strong compliance program in place is going to be important. I'm going to go back to due diligence, that if you're using any third parties for lending services, that you know, credit unions complete due diligence to make sure those third parties are following all applicable laws, because ultimately the credit union is going to be responsible. I think, you know, I'll also say fair lending is really broad and, for lack of a better word, a lot. And so, you know, we understand that. And while it has been a focus and a priority for several years, our approach is to kind of break it down and look at different areas each year. And so for this year, examiners are really going to be focused on loan pricing discrimination, steering discrimination, and appraisal bias. And so that's what credit unions can generally expect from us, unless, of course, there's other, you know, potential red flags or issues that have been identified in this space, in which case we might do a deeper dive.
Okay. Now, do you recommend, you know, a credit union understanding and knowing their own individual HMDA data to kind of help support these initiatives?
Yeah, I think that's important, that they, you know, have an understanding of the information they're submitting, you know, where they are in the space, and again, any weaknesses or risks that they have, because if they're, you know, it always goes better if credit unions identify risks or weaknesses and let us know versus us finding them and letting the credit union know. So.
Excellent. So, you know, the next question, you know, I only have two more questions for you, and then you're off the hot seat, I promise you. Well, technically, I sort of have three more questions, but one of them's a softball.
All right.
You know, there has been clear emphasis by NCUA and Chairman Harper on consumer protection. Can you just summarize that for us?
Sure. So it's absolutely a priority of his that's reflected in the agency supervisory priorities over the last several years, a lot of the initiatives and that he undertakes and that the agency is moving towards. I know the board last year approved for us to have create consumer compliance SMEs, and so we're really kind of increasing our emphasis in that area. And I think, you know, I've heard several reasons of why it hasn't been in the past, and that, you know, I talked about kind of the top three risks of interest rate, liquidity, and credit risk really, you know, being material to a balance sheet and failures. And I know people have said consumer compliance doesn't necessarily, you know, cause credit unions to fail, but it doesn't mean it's not important, and doesn't mean that consumers don't, you know, deserve to have someone looking out and making sure that credit unions are following the rules, and not necessarily because they don't want to, but right, everyone has blind spots. And so, yeah, we're looking at it a little bit more closely. And again, it's such a large undertaking that we're kind of, you know, each year looking at certain areas. And so credit unions can have a good understanding or idea of what we're going to look at when we come in, and not, you know, necessarily be caught off guard.
So I guess to that vein, and really it's kind of also another two-part question, but how does the NCUA consumer compliance relate to that of the CFPB and its rules and priorities, really? I guess the second part of that question really is, does the NCUA staff interact with the CFPBs to align their activities?
Yeah, so that's a good question. As far as rules, most of the rules that we examine for related to compliance are CFPB rules, and we actually examine for them under guidance and exam procedures developed as part of the FFIEC, which CFPB is part of. And so that's one way that we work closely with the CFPB in that area. As for priorities, so kind of the process for how we determine what compliance areas we're going to review each year, it's a mix of, looking at areas where we've seen a lot of complaints, or if there's new rules, which is maybe where the CFPB would come into play if they've issued something new or different, or just areas that we haven't looked at in a while. And so that's, kind of the thought process we go through to think of our priorities. They aren't 100% aligned maybe with what the CFPB and their priorities are. But we obviously with credit unions over 10 billion work even closely, more closely with the CFPB because they have examination authority over those credit unions. But we often share resources as far as we've participated on exams with them just to help develop and train our staff. They've had training sessions and invited our staff to attend. And so it is a good working relationship.
Okay, awesome. Well, thank you. Well, Amanda, those are all the questions I have. And so before we wrap things up, here's kind of like that softball question for you. Any final words? And that has a question mark at the end of it.
Oh, so I don't have anything really profound, but I will say, we kind of talked a lot about the outlook and the concern and with recent events, but I will say that, when we kind of do our analysis, for the most part, generally credit unions are in a really good position. We came into this year with strong liquidity, strong net worth. And so we feel good about that. I would also just say if there are credit unions that need support or help to, reach out, and, we have resources available. Happy to help. And if there are ever any questions, we really encourage communication at all levels, starting with the examiner, but always feel free to even reach out to the central office with questions.
Okay. Well, Amanda, thank you for today. Thank you for spending your time to speak to our group. We truly do appreciate it. That's all I have for you. So thank you.
Thank you so much.
Of course, of course. Now, thanks again to Meridian Link for sponsoring today's webinar. And again, to Amanda, who was fantastic for her valuable insight. And to all of you, thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us today. We truly hope that you enjoyed today's session. And finally, don't forget to check out acuma.org and our community page for all the latest updates on our in-person events. Everyone, enjoy the rest of your day. Take care. Bye-bye.